Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. June 29 Market Commentary Analysis. This video presents a direct informational narration of the source document. Welcome to today's explainer, where we'll be breaking down the major structural shifts, sector dynamics, and key corporate actions from the latest market session. Starting with the morning session, the market dynamics were heavily influenced by a mix of geopolitics and institutional flow. Initially, a brief pause in Middle East geopolitical tensions actually led to a pre-market rally. This pushed the S&P 500 up to test its upper resistance levels right at the open. However, we then saw heavy selling pressure step in. This abrupt intraday shift is attributed to an estimated $30 billion in equity liquidation, driven by U.S. pension fund rebalancing. So, how did the broader market digest that selling pressure? Well, the bulls successfully defended the critical 5450 support level. By absorbing that $30 billion in liquidation, it sparked a broad, tech-led rally across the board. The major indices posted solid advances, with the Nasdaq surging 2%, the S&P 500 rising 1.18%, and the Dow Jones adding 0.5% by the close. Underneath the surface, we're seeing some notable structural improvements in market breadth. Currently, 46.5% of S&P 500 constituents are trading above their 200-day moving average, which is a solid step up from the previous 43.6%. What this indicates is that the pullback we saw in June was likely a healthy internal rotation of capital, as the major indices managed to successfully reclaim their 50-day moving averages. Now, examining the valuations that are driving some of this July optimism, the S&P 500's forward price-to-earnings ratio currently stands at 20.1 times. To put that into perspective, it is sitting slightly above both its 5-year average of 19.9 and its 10-year average of 19.1. Naturally, sustaining those valuations relies heavily on the upcoming Q2 earnings outlooks, and we're seeing a bit of a divergence in institutional projections. On the optimistic side, you have Goldman Sachs and Bloomberg projecting 22 to 23% earnings growth, largely based on the idea that the AI dividend is spreading broader into the economy. On the more cautious side, Morgan Stanley and JP Morgan are warning of a potential Q3 correction, specifically citing the risk of tech premiums if downstream AI return on investment fails to materialize, or if consumer sector margins start shrinking. When you synthesize these institutional views, it suggests that market optimism is likely to persist as we head into the Q2 earnings season. But it's also deeply supported by what we call historical July seasonality. This refers to a statistically consistent pattern where the U.S. stock market tends to exhibit exceptional strength, heavily concentrated in the first 2 weeks of July, usually driven by mid-year capital deployments. To give you some hard data on that seasonality, historical tracking since 1985 indicates that the Nasdaq 100 has a 76% probability of rising during the first half of July. On average, this specific window has historically generated a return of 2.2%. Moving to Section 1, AI infrastructure and memory sector dynamics. Shifting our focus to the semiconductors sector, the SOXX index rebounded by 3.83%, and this was driven entirely by a notable rotation of capital toward upstream AI infrastructure and equipment providers. The mechanics of this capital rotation are quite interesting. Currently, there's friction over profit distribution and pricing between the massive cloud giants and the memory chip manufacturers. Because institutional funds generally want to hedge against that kind of uncertainty, we're seeing capital avoid the direct conflict zone. Instead, funds are rotating upstream into semiconductor equipment makers, companies like Applied Materials, Lam Research, and KLA Corp. This dynamic was incredibly evident when you look at Micron's extreme volatility during the session. The stock dropped 10% intraday before eventually recovering to close up 1.14%. Alongside this price action, Goldman Sachs actually downgraded the memory sector, citing several structural risks. They pointed to slowing momentum in high-bandwidth memory, increased competition from Chinese legacy capacity, and a potential deceleration in broader AI server investments. Further complicating the landscape for the memory sector are some emerging supply chain pressures. A group of 14 consumer retailers has launched a class action lawsuit against major manufacturers, specifically Samsung, SK Hynix, and Micron, alleging price fixing. At the same time, reports have emerged that Apple is seeking government exemptions to purchase Chinese legacy DRAM, a move that could force new pricing negotiations across the board. Finally, let's look at Section 2, Space, Telecom, and Corporate Restructuring. We're going to conclude with a series of significant corporate actions spanning across the aerospace, telecommunications, and digital asset sectors. We saw some key corporate moves impact the market. There are reports of SpaceX's upcoming inclusion in the Nasdaq 100 scheduled for July 7th, which is expected to drive about $4.3 billion in passive buying inflows. We also saw BXC execute a massive $25 billion bond issuance, though it notably experienced an immediate break below its issue price. Meanwhile, Charter Communications saw its stock rise 9.4% by the close, following the announcement of a new mobile partnership with SpaceX. Looking at strategic M&A and splits, Rocket Lab shares jumped 16% after announcing they are acquiring IRDM for $54 per share in a mix of cash and stock. Over in the telecom and media space, Comcast closed up 4.53% after officially announcing a tax-free corporate split, which will divide the company into separate media and telecommunications entities. And to wrap things up, MicroStrategy rebounded 12.6% upon announcing a massive $1 billion buyback of its Class A stock. These kinds of moves clearly position the market for aggressive institutional posturing ahead of the June closing bell. So, looking at these complex capital rotations and structural shifts, what key trends will you be watching as we enter the second half of the year? Keep the discussion going and let us know in the comments below.